and welcome to the latest Retire Well episode with me, Matthew. And as always, I'm joined by Joe. And today we're going to be thinking about inheritance tax, and we're going to be working through a few case studies. I think with pensions starting to fall into people's estate, it's bringing in those conversations with more and more people about what is an estate, what is estate planning, and what should people be doing.
Yeah, absolutely. I feel like when we look through these sort of case study type episodes, it really helps to maybe pull at different things. Sometimes me and yourself have slightly different views on how stuff works. So it's just quite nice to sort of work through them and hopefully you might see yourself in some of these case studies and get a little bit of an idea of the sort of things you could be thinking about. Before we do that, we will jump into the jargon buster as usual. And today I've gone with pension death benefits or death benefit nomination form. Matthew, do you want to sort of run through that to start off with?
Yeah, so people often ask about pension death benefits, and age 75 is that sort of clear bit to say if someone passes away before 75, they're leaving their pension death benefits tax-free for their beneficiary, and if they pass away after 75, it's then taxed as taxable income. And then in terms of the logistics of how that's achieved, people want to nominate a death benefit nomination form to outline who they want to benefit or potential classes of beneficiaries. We've talked about it in previous episodes, but there is a slight distinction between a defined contribution pension and a defined benefit pension. But with both, it's still important to have an active nomination so that you're letting the pension trustees know who you want to benefit, essentially.
Yeah, and we're mentioning sort of pension death benefits, as Matthew said. There's a change coming in 2027 that will bring pensions inside the estate for inheritance tax purposes, and therefore they are quite important. Although they're not taxed now, it's something that we're going to be looking at in the future quite a lot with our clients.
Definitely, and one clear exercise that we're doing for a lot of people at the minute is almost saying, with these changing rules, people are saying, okay, well, what's my estate today with the pension sat outside it? And then what's the same sort of numbers if I put the pension into it, and whether that pushes someone above an IHT threshold or whether it changes their plan and thinking for the future.
Yeah, I mean, an ex-Chancellor Roy Jenkins, or Chancellor of the Exchequer Roy Jenkins, did say inheritance tax is a voluntary levy paid by those who distrust their heirs more than they dislike inland revenue, which I suppose was a little bit of a tongue-in-cheek comment. But what that's saying is it's not something that you have to pay, because if you pre-plan, you can gift, you can spend, you could potentially insure your way from it. But I suppose the question that I have is, with pensions coming into the estate for inheritance tax, is that still the case? Because pensions, obviously, you bring in another level of taxation if you're wanting to withdraw those pensions and give it away. So I think it's maybe still true to an extent, but maybe just a little bit more complex than that.
I think it's changed a bit. I think with those comments there, that was very much okay, you've got assets that you could gift and you're choosing not to. If someone has a large pension now, say it was worth £1 million, to access that money, they are paying tax. So they are already then, starting that bit that Roy Jenkins was mentioning to say, oh, well, you can essentially, if you plan early enough, you don't have to pay the tax. On that example, well, you're sort of then stuck between when and how do you pay the tax. So I think it has changed to some extent. And I think, people's largest assets tend to be properties, and then it might be pensions. Again, how often are you going to be extracting wealth from a property? And can you extract significant chunks of wealth from a pension without any tax? So maybe it'd be interesting to see if Roy has changed his tune now.
Yeah, it is. So I'll start off with scenario one. Got a couple, John and Susan, both age 70. They're married. Their home is worth 600,000. They have ISAs of 300,000. So currently, pre-2027, their estate is 900,000. If they haven't made any gifts, they're not likely to be subject to any inheritance tax. But they have pensions of 400,000 combined. So that'll push them above that £1 million threshold of 2 nil rate bands and 2 residency nil rate bands. And there's potential there that 300,000 of their estate would be subject to IHT, so a potential tax bill, if taxed at 40%, of 120,000. What are your sort of initial thoughts on that scenario, Matthew?
I think this is the perfect scenario we're having recently, where conversations with this sort of couple are, I didn't have to think about inheritance tax. That I wasn't a worry. I was almost going to be within a threshold, and any extra that was left in a pension could have been that IHT planning tool that's passed down the generation. With the refocus and change on pensions, there is that then taxation that would apply. And that's sort of prompting these conversations almost to, focus more on what is the ultimate objective? Is it to pass on wealth? Is it to minimize tax? Or is the answer, okay, well, we're still happy that we've got the flexible spending from an ISA and a pension, and we've got the property that we want. So actually, we don't need to do anything. We're just aware that there is, a tax burden that would apply now.
Yeah, I mean, I think this comes down to probably one of the reasons that Labour brought in the pensions into the estate for inheritance tax. They see, and a lot of people see pensions as something to be used in your lifetime.
Yeah.
So for John and Susan, this might not actually be an issue if they plan on spending 300,000 more of their pension before they were to pass away.
Yeah.
I mean, unfortunately, you can't choose when you die. So right now, they don't have anything. In 5 years or 2 years' time, in 2027, they will have that liability. I mentioned 5 years. I think that's because I was already thinking about the pre and post 75 rules, because that also brings in sort of another layer of complexity to the inheritance tax situation, particularly with pensions. So just to set it out, the rules at the moment, you can completely inherit a pension tax-free. There's no inheritance tax on there. And then dependent on whether you were to die pre or post age 75 depends on how that's taxed. So at the moment, if you were to die before age 75, that is completely tax-free. You can do beneficiary drawdown, and essentially the beneficiary, whoever it may be, your spouse, children, can draw on that completely tax-free. Post 75, it still passes to them tax-free, but if they were wanting to do beneficiary drawdown and draw it out, the income is taxed in the same way that your sort of non-tax-free income is taxed in your pension. So at basic rate, higher rate, or additional rate tax, dependent on what the beneficiary's pension is. And that, I suppose, when you combine them now, those tax rates, 20% isn't necessarily too bad. It's the same as you'd pay in your pension. But post the 2027 changes, that means that it can actually result in pretty large tax rates, to be honest, for the beneficiary.
If you're factoring in that inheritance tax sort of burden as well.
Yeah, I mean, if just for argument's sake, if you were to take the pension post 75, you're taxed at 40% anyway, and then the beneficiary was immediately to take everything out all in 1 year, which probably isn't advisable. If your basic rate or the beneficiary's basic rate is a 52% tax rate, all the way up to a 67% tax rate for an initial rate taxpayer. So it's not just that 40% inheritance tax that we're really, really worried about.
Yeah, and I think why do we have this conversation now, and why do we think about it now? Well, it's going back to that, well, what should John and Susan do now? In their current circumstances and the current rules, there was always a view that if you've got a choice between spending a pension and an ISA, well, I should spend my ISA first because that's going to fall into my estate for inheritance tax. It's completely tax-free. And then actually, if I'm leaving pensions, if I pass away before 75, it's completely tax-free. And if I pass away after 75, it's just going to be taxed at my beneficiary's marginal rate. There's a slight reframe to that now with the new rules come in, that you sort of say, okay, if both are in my estate and one is tax-free and one's potentially taxable income, am I actually trying to use both at the same time, or am I starting to almost use my pension before my ISA? And again, there's not a simple answer. It's all based on circumstances, but it all is almost a changing of a mindset to say you've got to be a bit more clear on what your objectives are before you start using the various taps to achieve.
Yeah, and I suppose it depends what other income John and Susan have, because if they're higher rate taxpayers already, do you want to take out money at 40% to save 40% in the future?
Yeah,
it's a thing. I mean,
and also the sort of beneficiaries and what they're wanting to do with it. If they've got grandchildren who are buying their first houses, again, there's logical life events that they might want to say, well, now's the top time for us to gift. If they actually said, oh, well, we've got children who are very financially independent, who actually might end up having more assets than us, maybe estate planning becomes less of a priority, and it's more, have they got enough flexibility in their lifetime? Yeah. So these are the strands that we tend to pull when we're going.
Yeah, I mean, given these are flexible pensions, it gives you a little bit more option as well, because if it is the case that as you said, they're set for their life. They don't reckon they're going to use those pensions. You could look at nominating someone other than the surviving spouse as a beneficiary. It could go to the children, sort of bypass that second set. Or even we see somewhere it goes down to the grandchildren. Like you said, if children are already independently wealthy, you're only just creating a future inheritance tax liability for them. So yeah, I think that's one that it's do you spend, do you not? It's an interesting one to look at.
And I think just we won't touch on this for too much longer, but because we'll move on to some other case studies. But I think the logical conversation with this would say, if the IHT bill was a priority, then we're starting to work through the journey of simplicity. Life insurance might be an answer. Gifts could be an answer. Trust could be an answer. And then there's also specific products that benefit from reliefs with assets falling out of people's estate. So again, walking through those journey, we could quite easily bring this IHT liability down to nothing, but it would only be if that was the top priority at this point.
Yeah, exactly. So scenario 2 is slightly different. So single professional, Rachel, age 58. She's never been married. She's got 900,000 in assets and 500,000 in pensions. She wants to leave the majority of her money to her nieces and also a charity as well. What are your initial thoughts on this one, Matthew? What are the sort of planning points or pain points potentially that you'd be looking at?
I think this is a common area where people are frustrated that a single person has half the allowances of a couple. And I've got a good few examples of this with clients I look after where they sort of say it's not really that fair because I've still had to work hard, build up this position, and then I can't pass on the wealth to my children, for example, in the same way I could if I was still married and I hadn't had a divorce, for example. So I think in this scenario, again, Rachel is slightly younger, so it might be that there's more of a focus on what assets does she need to spend and draw in retirement. But if we looked at it now, obviously those assets are above her thresholds, and actually because of the level of it, she starts to lose allowances like the residential nil rate band.
Yeah, and just to not gloss over the allowances, because I'm aware we've run through them a little bit quickly. Your nil rate band is 325,000, and then residency nil rate band is 175,000. And actually, Rachel, although she'd lose it if she had sort of direct descendants, wouldn't be eligible for it now because she's looking to pass stuff over to her nieces. One straight away first question I'd be asking Rachel is, does she have a will in place? Because if not, it's going to drop to rules of intestacy.
Yeah.
And that just isn't going to get it to the nieces, to be honest. There'll be a fair few more steps before it gets to them. And then a charity wouldn't even be in the thinking that would go to the Crown if there was no one left. So I think that's a really important piece. And then also the death benefits that we always say, make sure that those nominations are on. And then after that, that's when we're looking at what do we want to do in our lifetime. And that's, again, when it comes down to, do we want those nieces to benefit now, or do we want them to benefit at some unknown date in the future? Yeah,
definitely. And I think with Rachel's age profile, I would be saying to her, make sure you're clear on having enough assets for you and what you're likely to spend in your lifetime. But if she's deemed that there's some assets that could be carved out for the next generation and to be passed on to the nieces, for example, that's when putting some of those assets into a trust would be perfect. If some of that sort of 900,000 is liquid, if it was in ISAs or cash, for example, and it wasn't in property, then she could set up a trust for the nieces and nephews or whatever as beneficiaries. She could be the sort of settler and the trustee. And then it could be a case of, well, I've started that 7-year clock for things falling out of my estate. But equally, if one of the nieces needed something for university or a house deposit or something, it could already be distributed from that, and it could be used as a loan from the trust, for example.
Yeah, exactly. And just to sort of touch on the charitable side of things, given that she is already going to be an inheritance taxpayer, if you leave more than 10% of your estate to charity, it reduces the inheritance tax total from essentially the top rate of 40 to 36%.
Yeah.
Although you are still giving some away to charity, if you're going to do it anyway, it helps with the rest of the estate to bring that liability down for the nieces.
Yeah, and someone asked the other day if political parties still count as charities for those donations. But again, I don't think they'll necessarily be getting lots of money given to them in their estates.
Yeah. And just final one on here, we haven't necessarily mentioned what her £900,000 in assets looks like. it would be very easy to gift if it's a £200,000 house and 700,000 in cash. If it's something like £800,000 house and 100,000 in cash, that's when further down the line, once the pension's been used up for income and there's not as much there, that's when it's something we spoke about in a previous episode, looking at something like equity release, where you're not going to be passing the property down anyway. You might want to pass it to the nieces, but you might not. And that might allow you to create a little bit of liquid capital that you could use for a gift in your lifetime.
There would be that question of, does she have plans to downsize? Does she want to release equity? Again, what's the priority and at what point in that journey? I think, again, I would be very sort of clear to Rachel that a lot can change between sort of 58 and life expectancy. So it might be worth having a plan, but not executing everything on the plan right now. But certainly doing the small things right. I mean, she could set up some regular gifting now, or if she had any surplus income, she could also be doing that now to start to reduce her estate and benefit those sort of nieces who are the key sort of plan to her.
Yeah, absolutely. Completely agree. So moving on to scenario 3, we've got Tom, 75, a widower, and he's got £300,000 in pensions, £900,000 in investments, and £200,000 cash. And he regularly likes to give £10,000 a year to his 3 grandchildren. He wants to explore in a little bit more, how can he give more in sort of his lifetime and maybe reduce down that inheritance tax. Matthew, again, first thoughts on that one?
Yeah, I think first thoughts, we would be asking, has he inherited the whole of his wife's nil rate band? So in which case he would have the 2 lots of allowances that we've talked about previously to go against his worldly assets. If some money hadn't gone to him and had been already distributed to children or grandchildren, then he might have the reduced sort of nil rate band that had been inherited. So there could be a smaller allowance for us to look at these assets against. But when we look at the planning angles, I think we're really thinking about, he is clearly showing a habit of gifting. So gifts is clearly a top priority. And does he want to start thinking about some larger gifts, possibly into trust or absolutely to the grandchildren? And by doing that, he'd be starting the 7-year clock and his estate would be starting to be reduced.
Yeah, I mean, I think those £10,000 gifts, obviously we're insinuating there that they could be gifts out of normal expenditure or gifts out of normal income, which is that sort of separate rule that isn't as well known, where if Tom has an income of 50,000 and he only spends 40,000, he could have that £10,000 there that's out of his normal expenditure and can be gifted. The crucial one here that we've mentioned a few times is that it's important to keep a strong record of this gifting, and it's important to show that it's regular. It might be something as simple as keeping those bank statements, keeping the dates that you've done it, and essentially writing in a letter that it's your intention to gift on a longer term basis.
Yeah, definitely. It's only sort of actually argued and demonstrated on death. So if the individual, if Tom's no longer here and his personal representatives then claiming that relief, they need a little bit of evidence, as you say, a bank statement, some dates, put the 2 together, and it should be quite simple. Again, the more complicated it is and the less pattern and the sort of more flexibility it's been, maybe that's harder for them to argue. So I think, we always say to people, keeping those clear dates and the figures makes it very easy.
Yeah, and other allowances, obviously, with gifting, you have your £3,000 gifting allowance each year, £250 small gifts allowance, and then additional allowances for stuff like marriages, which again, with grandchildren could make sense. I think an interesting one here as well, sort of away from the allowances, is he has 3 grandchildren now, but he could have more grandchildren in the future. So would it be the case that instead of gifting directly to the grandchildren, or maybe the grandchildren aren't actually ready to take on that 10,000 a year, is it maybe better to redirect this into some form of trust, which would allow these 3 grandchildren to be eligible for it, but equally if there was more grandchildren in the future, it could work that way. So that's one thing I think is worth thinking about. And then another one also on the trust basis. This may or may not have happened, but when Tom's deceased spouse passed away, would there maybe have been a planning opportunity prior to then to look at something like a will trust or a nil rate band trust, which would allow them to put $325,000 out of Tom's estate now into a trust? It can grow free of inheritance tax there. Just again, something that isn't always thought about in these sort of ones, and it's too late for Tom, but it's maybe not too late for others to look at that.
Definitely, and the same with pensions. Again, if his widow had some pensions, that she's already passed away, they would have been outside of her estate. Could they have been rerouted to the grandchildren to be slightly more tax efficient? Obviously, Tom's 75. If she'd been 75 or younger, that would have been completely tax-free. If Tom had inherited some of her pensions, that could be through beneficiary drawdown, and he could potentially draw the whole of that pension without any immediate tax liability for him, and he could then potentially gift that. Again, these are more questions that we'd have for Tom in relation to how his pensions and investments are made up. But certainly if gifting is a top priority and his income need is already met, then we can start to say, okay, you might be slightly overweight on cash. You could start to gift that. These investments, what's your objective with them? And do you want to start gifting a portion of that? And is there anything that could be done efficiently with the pension?
And I think maybe an alternative or an additional thing for Tom to think about that maybe Rachel doesn't have to, or John and Susan, is the fact that he is 75. And I'm not trying to kill John off straight away, but hope he does live to sort of grand old age of 100 and gets his card. But he's now got a more limited time frame of gifting. You think if he was to make a large gift now, he has to get to 82 before that's outside of his estate.
Yeah.
And then the sort of second 7 years of gifting again, it's going to push you even further. So maybe Tom needs to look at something that's, if he's really concerned about inheritance tax, about something that will maybe give you a little bit more of an immediate relief. And that's when you can look at a couple of different options. The one that springs to mind for me would be a discounted gift trust. So that if he's got a good amount of cash or investments available and does still need an income, because a discounted gift trust will give you an income back in a sense, but you could invest in that trust, and it's essentially split into a couple of different parts. One part is the return of capital that could go to Tom, which is treated as that sort of income element, and then the other part remains within the trust, and that could be for the benefit of the grandchildren. But the key bit about this is it looks at what bit is Tom eligible for, and that's discounted from the total value that would be the gift into trust. So he could potentially have on a £900,000 investment, a reduction of sort of 40-50% of that value that would be immediately outside of his estate for inheritance tax purposes.
Yeah, definitely. We've recommended a few discounted gift trusts recently where it's been a perfect example where someone is, capital rich, and their main reluctance to give that all up now is, what if I need an income from it? So the discounted gift trust essentially carves out a portion of the income, which has to be taken. Once that's set up, it can't be adjusted, but that income then creates that immediate discount, which drops out of your estate straight away, where they're essentially saying, based on your life expectancy, you'll take this income, and as a result of that, you've got an immediate IHT saving. So the benefit is, a large amount of money can go into trust. You can have that immediate saving, and also that person said, okay, well, I haven't had to give it all up. I've still got an income coming in to keep me as being financially secure.
Yeah, and without going into too much detail on discounted gift trusts, because they can get a little bit more complex, the underlying investment will be held in something like an investment bond, which means you need to look at the amount of income you need out, because if it's above 5% of the investment you put in, that could create some more complex tax charges. So something that I think is worth looking at and exploring, but maybe a little bit more complex.
And I think just a red flag on that one, it's such a complicated area. It's something that you require advice from.
Yeah.
The idea of doing a DIY discounted gift trust just isn't.
Yeah, and similar with that for Tom, something that doesn't give you immediate relief, but would give him relief in 2 years as opposed to 7 years, is it'd look at some form of business relief product that qualifies for inheritance tax. They've been limited slightly in the last budget, but still valid and something that might be worth exploring. But as you mentioned, Matthew, when we're looking at how do we solve an inheritance tax problem, we start with the really simple things first. We look at, can we gift away? If we can't gift, should we look at something like life insurance? Do we need to look at gifts into trust, discounted gift trusts? And then those sort of more complex products, because they do come with a level of risk. They're much more risky than the other one.
Yeah, and I think that the rule I would say is, don't let the tax tail wag the investment dog. And if someone hasn't got that appetite for risk, then it's a non-starter when it comes to the idea of the potential inheritance tax saving. It's not worth taking undue risk simply for the IHT benefit.
Yeah, okay. And looking at scenario 4, sort of moving on from that one, we've got David, who is 68, and he's recently received an inheritance. So he's recently received £400,000 in investments and £400,000 in pensions. He's already independently wealthy, so potentially subject to an inheritance tax charge, and he's got 2 children and 4 grandchildren. What are sort of the immediate planning angles on that one, Matthew?
Yeah, I think I would have liked to talk to David, prior to that inheritance, just to say, is there an element that we can do something like a deed of variation? Again, there can be a point where if you are already independently wealthy and you've got an inheritance coming in, you could start to say, well, skip me, and then we skip a potential IHT position. Again, with the pensions, could they be rerouted to the children or the grandchildren? But assuming that that's already taken place, then the focus would be on David himself, and then saying, okay, what income's he got? Has he got an income surplus that he can gift? Does he want to think about setting up trusts himself? Again, 68, he's got, on a normal life expectancy, he's got a couple of 7-year clocks in him. So does he want to start thinking about gifts into trust and those sorts of planning? But equally, let's not forget the basics. Has he got the will in place? Has he got the death benefit nomination? Does his wider financial picture match what he's trying to achieve?
Yeah, you mentioned sort of wanting to speak to him prior to the inheritance. I suppose the benefit of a deed of variation, it depends how recently he's inherited it. If he's inherited it in the last 2 years, he can still vary the inheritance. And with that sort of thing, it just needs to be anything that the beneficiary has. So even if there was 400,000 that's gone to David's brother or a cousin, it's only that 400,000 that he could vary and could move. But that is a benefit, because if David's independently wealthy, that's just adding to his estate now. Whereas regardless of whether it's already paid inheritance tax from let's say it's a parent, they can essentially class it as a gift from David's mum or David's dad down to the grandchildren, which I think in this case would potentially be a good one to look at. And again, if the grandchildren or children, you don't necessarily trust them, you could look at varying that inheritance into a trust, which could be a benefit there. The pensions that he's received, I think, depends on sort of, is it been received from if it was a spouse or something and they were a similar age to David, they would be tax-free for David to draw down. So those 400,000 in pensions could be drawn out tax-free. But if David survives 7 more years and goes past 75, if David was to die, they were to be taxable. So that's another bit of a planning point when you receive the pensions. You need to look at sort of, where do they sit? Are they invested correctly? Because they might be different. Probably moved it down into cash when you went into beneficiary drawdown. But is there an opportunity there for me to draw down on a pension tax-free where otherwise I'd be accessing my own pensions that potentially could be taxable?
Definitely. We did a great bit of planning recently where a client had a large pension and she was over 75, but she'd inherited it from a spouse who'd passed away before 75. So for her, that whole pot was tax-free income. But if anything happened to her, if she was hit by a bus, the pension would be left to her daughter, and that would be taxed at her marginal rate. So again, the opportunity there was, okay, as it stands with pension rules, you could see why she would just leave that currently outside of her estate for inheritance tax and do nothing. With the proposed changes and those falling into her estate, there's more of a, well, I should act now, and I could draw the whole of that pension down, start to think about, a large gift, and then because it was a large gift, some life insurance on the side of that to cover that 7-year period. And quite quickly, that takes what is a upcoming inheritance tax liability with the change in rules to being something that, has been mitigated by the life insurance and the gifts.
Yeah, and again, pre-planning on this one, maybe it would have been worth looking at some form of nomination change. So instead of it going to David, it went down to the children. But I think that's key when it comes to inheritance tax planning. We have a lot of people that might have one issue or their parents might have an inheritance tax issue, but they don't necessarily talk to each other. It's really important to talk to each other, talk about the goals and objectives. Firstly, from the sort of the elder generation to work out what their goals are. Are they sorted? Are they going to spend it down anyway? And then secondly, for the younger generation, would it be potentially useful to receive a gift now or in the future? Do they need it? Because if they don't need it, could it pass down to another generation?
I think that intergenerational planning is key, and I don't think it quite happens enough, really. And then to throw a spanner in the works as well, we have had situations in the past where, this example for David, say it's come from a parent. We've had examples in the past where, if we were looking after David, we might say, okay, tell your mum and dad you don't want to benefit, you'd rather you pass on to their grandchildren. And sometimes you've heard things back to say, oh, well, yes, that's fine, but actually we want you to benefit as our son, so we are still nominating you. So again, from our point of view, we can only, bang the drum for what is the tax efficient, solution. If they then say, oh no, actually, we want to provide for you, and if you choose to then pass the money on to your children, that's fine. Again, there's not much you can do to argue at that point.
Yeah, absolutely. Do you have anything else on that scenario?
No, I think it's a really interesting one. I think it comes down to exactly what you said there, the communication and the pre-planning. I think some people don't want to talk about these things because the idea of thinking about death and estates can be a bit sort of depressing. But ultimately, when there's large numbers and figures involved, the earlier these conversations are had, the earlier something can be structured and the easier it can be probably to achieve that tax efficiency.
So moving on to scenario 5, we've got Chris and Helen, aged 65. They've got a £350,000 house, £200,000 in pensions, and £300,000 in cash and investments. And with pensions coming to the estate in 2027, they're a little bit concerned on what inheritance tax they might pay, and they're wanting to make some gifts to children. What are your sort of, again, immediate thoughts on this scenario?
Yeah, I think this is a common one where newspapers and other things are sort of scaring people into thinking that inheritance tax is coming for everyone. In this situation, their assets fit nicely within their allowances, so there's no immediate inheritance tax due. So the initial thing we would be saying to them would be, don't panic. You don't have to change any planning initially, but if your top priority is to think about making gifts, then you've got the ability to potentially, do regular gifts, to do a lump sum gift, and again, you've got capacity within your nil rate band and the residential nil rate band. The numbers there we've described, the 350,000 fits perfectly in the residential nil rate band. Again, they're 65. If those values of the property keeps going up and the allowances are frozen, then there's a chance that their assets could get above that £1 million threshold that we talk about for a couple. But in reality, when they've got a view on gifting, it's likely that they'll sort of keep themselves within that threshold.
Yeah, I think that sort of the gifting above sort of normal expenditure or that standard 7-year rule is an interesting one, and maybe worth spending just a little bit more time on the way that those nil rate bands actually work. So let's say they were going to gift, I don't know, 50,000 to 2 children, so £100,000 total. If they live 7 years, brilliant, that's outside of their estate and there's no effect on their nil rate band.
Yeah.
If they were to die within 3 years, what essentially happens is that 100,000 is taken off their 325 nil rate band that they could use on death.
Yeah.
So instead of them both having 325, one of them might have 325 and one of them might have 225 nil rate band. But given the value of their estates below that £1 million anyway, it wouldn't actually have an impact. If it did, and they had an inheritance tax liability after that reduced, then you get into what's called tapering rules, where for the first 3 years you pay the full rate and then it tapers down each year to nil rate after 7 years. I think it's something that, again, it's a little bit misunderstood on how it works, and a lot of people, regardless of how much they have in their estate, assume that you need to make that 7-year gift before sort of falling out from an inheritance tax burden. Yeah,
definitely. And I think it does come down to that, the first reaction where someone says, if there's a gift or there's an inheritance or there's an estate, and they say, okay, there must be some tax due. I think, there's more clarity when people understand the figures. I mean, I had a question from someone yesterday, and it was like, a client of mine said, just a quick question on a family friend. They've been, they've inherited £50,000. What's the tax that they would have to pay on that if their, parent passed away within 7 years? And you go, okay, well, that's, what's the wider circumstances? Oh, well, they've got a house, it's probably worth 150,000, not a lot of other assets. So you go straight away, there's a lot of capacity and there's never going to be any negative tax consequences. But that person who's received the gift received it with a unknown information and a bit of a worry to say, am I going to have to pay 40% of this back at some point because of the potential unknown tax situation.
Yeah, and let's say, just for argument's sake, instead of having 300,000, they had 700,000 pound in cash, so a clear inheritance tax liability there. What and we get this every so often. What would you say if they were wanting to actually take that house that they have and pass it away into a trust or gift it to their children to try and reduce that liability?
Yeah, I mean, I don't love gifting, the main residence into trust because, it could be a gift with reservation. It could be something you then have to start paying market rent on to ensure that it is a true gift, and it would start falling out of your estate. And equally, depending on how you've gifted it, if you've given it absolutely to children, for example, and they were to get divorced or go bankrupt, again, that's no longer your house, so you could have a massive detrimental impact there. And even putting into trust, if you then came to move and you needed a mortgage or other things, there's a lot more hoops to jump through. So my sort of compromise there is, with a couple, you could sever the tenancy, so go from being joint tenants to owning it as a partnership that will move naturally between each other. If you move that to tenants in common, you can carve out your share, and on a first death, essentially in a will, you can pass that on to the next generation, but you leave the surviving spouse as that remainder man who can carry on living in that property. So there's a bit of jargon in there, and it's a little bit complicated, but essentially the compromise is that you've ring-fenced half of the property, avoiding things like care home fees and having a bit of that efficiency for estate.
Yeah, and those care home fees will obviously only be sort of avoided on that first death scenario, but it's protecting some of that family home. I think the key one there, a lot of people, if they do look at gifting into trust, which to be honest I see maybe too often than I'd like to see, is they've put it into trust, brilliant. They think that it's a gift that's been made, but they're not paying a market rent on the property, and that, again, that brings in gift reservation and would pull it back in for inheritance tax purposes. And then another issue that we haven't necessarily spoke about today is stuff like care fees. If people are doing that for a care fee purpose, but are close to going into care or think they might need care in the future, then you're potentially liable for sort of looking at deprivation of assets, and the care home could have a go at that anyway.
Yeah, and I think it also comes in at those ages of when people want to do this. If it was, Chris and Helen at 65 saying, I want to gift my house, there's a lot that can happen in someone's life between 65 and their normal life expectancy that you maybe can't necessarily plan for. So they almost need to have that flexibility, and making sure they still have the asset and the ability to act accordingly could be the right thing for them.
I mean, moving house is clunky at the best of times. If it's been gifted or it's in trust, then it's a whole nother layer of red tape, if it's even possible at all.
Yeah, definitely.
So moving on, just to finish with our listener's question, around pensions and estate planning naturally. So with pensions included in the estate from 2027, should I start drawing mine earlier to help reduce that inheritance tax, or look to other bits to draw from?
Yeah, I think this comes down to what we talked about earlier, where, the previous situation when a pension was always outside your estate, you might have spent cash, ISAs, and preserve your pension as a potential IHT tool. There's a view now that you might want to do a bit of both. You might want to spend a bit of cash, a bit of ISA funds, for example, and the pension. But it really depends on your wider circumstances. I certainly wouldn't say to someone who's going to be paying higher rate or additional rate tax, just draw down on your pension for the sake of it, because there's tax to pay. But there's scenarios, I've had one with a client recently where they've said, okay, if I can draw some money down from my pension and pay 20% tax, if I'm going to gift that to my two sons who are then going to actually put money into their pensions, they're almost going, well, I'm paying some tax, they're getting some tax relief. So the knock-on effect is we've moved money to where we want it to be.
Yeah, I mean, I think that the answer to this, there's so many intricacies to it, because it depends on the tax rate of whoever you're going to be gifting to, whoever's going to be inheriting your estate on death,
Yeah.
It depends whether you were to die pre or post 2027, and it also depends whether you were to die pre or post 75.
Yeah.
Another thing, I suppose, slightly alternative view is if you get a couple and have a estate over £2 million, you start to lose your residency nil rate band, and if a pension causes that, I mean, I've been at probably too many seminars recently looking at sort of how do we plan for this scenario, and that sort of essential effective tax rate if you were to be dying post 75, reduced residency nil rate band due to the pension taking you over £2 million. and have a successful son or daughter that pays 45% tax and they draw it out all at once, the effective tax rate's something like 93% when you take all of that in. And I get that's an extreme scenario, and it's probably not one that would do, but then it's not 40 versus 40 then, it's 40 versus 93. But there's no hard and fast rule with this one, I don't think. It's all about looking at current circumstances, what you want to do, and equally, if you draw in from your pension anyway, you might actually reduce your estate down below that inheritance tax threshold.
Yeah, I think the boring answer is everyone's circumstances are different, but I think the relevant answer is it's worth thinking about whether someone should adjust their planning because of the change in the rules, but it's not necessarily yes as an answer.
Yeah, absolutely. So just sort of summarising, what I think the key takeaways is first of all, start with the simple stuff. Make sure you've got that will, death benefit nomination form in place. And then if you still have an inheritance tax liability, move on to looking at gifting, life insurance, and then only really get up that ladder if those first ones don't solve it for yourself.
Yeah, definitely. And I think, we know there's things like discounted gift trusts that we've been recommending. It's got to be right for the circumstances. It's got to be right for the level of risk. And that's definitely where you want a joined up plan in place.
Yeah, absolutely. So thank you very much for watching again this week. As always with an episode like this, it's great to hear your own scenarios, see if you see you reflected on it, or if you've got a different sort of opinion on how it should be planned. So feel free to leave a comment, and we'll be back next week for another episode.